Nitin Raheja too joins in the show. Nitin, hi, afternoon. Just looking at the big drag that ICICI Bank is turning out to be, a bit of a disappointing commentary, one should say, and especially the fact that because of the moratorium option, 30% of the corporate book ended up opting for the moratorium. And it seems that because of that, they will have to provision much higher in the coming quarters as well. Your take on, as an investor, what should be the approach for ICICI Bank now?
So look, the fact that I think if you clearly see the trend of results as has been coming out, the initial banks which came out with the result, as time has gone by, more and more people have been opting for the moratorium and so on and so forth. So you are seeing the fact that the later banks, whether it was Access or whether it's ICICI, have indicated that there has been a greater trend towards the moratorium. Now, how much of that will really translate into higher credit costs at a later date is something that we need to see as such. However, let's understand both these banks, after a considerable amount of time, had cleaned up their books and were coming back on the expectations of a wholesale revival, and they were building their retail book. Unfortunately for them, the whole retail story has taken a big hit because of the whole COVID virus, pandemic outbreak. So I think to that extent, a lot of their targets that they had set for the revival, for achieving their ROEs, have got delayed further. So I wouldn't be surprised if the entire the banking pack as well as the NBFC pack continues to remain under pressure as and when news keeps coming out. But having said that, if you look at the valuations that have now come down to whether it's the ICICI or Access, they are very, very attractively priced. They are priced close to their historic lows as such. So, we would really believe that whether it is ICICI or Access or Kotak or HDFC, these banks will actually benefit in the form of higher deposits coming their way. Also with the whole mutual fund issues that have happened, people are once again jumping into and putting their money back into deposits. So their CASA ratios will go up and so on and so forth. So I think these banks will garner that, and whenever credit growth and the economy comes out, these will be the banks who will actually drive it because they would have significantly showed up their capital.
Getting pretty close to that support of 320 that Kunal had earlier highlighted to us. CK, I wanted to ask you about private banks in particular. Now, we know that financials at large, NBFCs in particular, have had that pressure for almost a fortnight now. But in particular, Kunal, I'll ask you that question. The weakness that one is seeing in ICICI Bank, do you see that trickle on to some of the other stronger ones like an HDFC Bank or for that matter, Kotak? Or do you think this is going to be restricted to ICICI Bank? Because largely, like Nitin as well highlighted, the same concerns that you saw in ICICI Bank's earnings would apply to even an HDFC Bank or a Kotak too, perhaps.
And I think it's a valid statement because what happens to ICICI Bank in terms of the price performance or in terms of the expectations post the result, has a similar impact or more or less a similar impact on the other top candidates like the HDFC Bank and Kotak Bank, because they tend to generally move in tandem, both in terms of the longer term price structure as well as in terms of short term worries as well. So I completely second that statement. Also, if you look at it, just look at today's example. I think ICICI Bank is taking away around 28 or 29 points from the Nifty. So that's a huge impact, and that's the only stock which is losing double-digit points on the Nifty today. So you can see the impact of ICICI Bank not just on the bank Nifty, but even on the overall market as well, on the Nifty as well. Bank Nifty is down, I think, if I'm not wrong, 700, 750 points from the opening highs. And primarily the reason for that has to be attributed to what's happening to ICICI Bank. So I clearly believe that the stock generally and definitely has an impact on not just the other private sector banks like the HDFCs and the Kotak, but even to the overall market expectation as well. And in such kinds of price scenario, you generally have to wait for confirmation of breakdowns. Yes, there could be some weakness which could happen. So maybe it's profit booking, which is post results, which is happening out. So we are not sure of what kind of data is actually panning out because of the running day. Maybe at the close of the day today, we'll get a much better hang that whether this is a complete unwinding of long positions on ICICI Bank or whether this is fresh short. But I think when you look at the market as such and the price scenario, then you have to wait for some strong support levels to be breached. 320 is what I indicated earlier. If that level gets breached, then I believe that there could be a more cascading effect into the other private sector banks as well.
All right. Let's take a look at the earnings picture so far. Let's go across to Vivek on how they're really stacking up on the Nifty. It looks like a fairly mixed bag, doesn't it, Vivek?
Well, as far as the earnings scorecard is concerned, the ET Now scorecard presents a very clear picture, even though that we are just around 25% to 30% as far as the earnings season is concerned. Now, when you're talking about, the Nifty 50 earnings candidates, almost 40 Nifty companies have come out with their results so far. And when you're talking about just two companies have managed to beat the earnings estimates, and one of them is the cement companies itself. Now, when you're talking about earnings candidates that have actually not meeting or in fact underperformed, you're talking about 5. So again, the pace of earnings weakness or the pace of earnings disappointments has been far higher compared to the earnings surprises. And when you're talking about mixed as well as inline, both, this too is quietly high, given the fact that a few companies or few banks like ICICI and Axis came out with a mixed set of results. Earnings themselves were not so disappointing, but the management commentary was something that was quite uncertain. On the other hand, when you're talking about the Nifty 100, over here, it's a slightly better picture, quite surprisingly. A lot of cement companies here as well that have actually held up the trend. 5 companies have declared earnings above the ET Now poll. Below, again, it's quite high, but still not as bad. 6 companies below the street estimates or below ET Now estimates. And when you talk about the inline as well as mixed, again, here the trend is quite high, given the fact that management commentary is something that is a bit of a worry. The other thing that you need to keep an eye out for, Goldman Sachs too has come out with its report. What they're saying is that out of the total universe that they have at this point of time, a lot of companies have actually underperformed the street estimates, and what they're saying at this point of time is that earning disappointment has actually been higher than the earnings surprises. So what Goldman Sachs is saying at this point of time is that they will be forced to prune down their EPS estimates further, and also what they're saying is that a management commentary as far as COVID-related crisis is something that's still a bit of a worry, and that is something that they will need to wait and watch for further. So interesting trend so far, quite a downbeat quarter due to COVID.
We're also watching out for Nestle's earnings, and it has been one of the stocks that has been standing out, but there are pressures here as well. Let's go across to Vinny, who will help us understand what's in store.
Nestle is to post its Q1 current year 20 numbers, and what are we expecting in terms of numbers? The revenue is expected to be at around 3,050 crores, marginally up by 2% on a year-on-year basis, while the profits is expected to see a 4% jump, and it will stand at around 483 crores for the quarter. Now, in terms of margins, we're expecting a decline of 150 basis points for the EBITDA margins. What is impacting the numbers? Now, obviously, COVID-19 and the lockdown across the nation and the globe is going to impact the sales of the company, but also the gross margins and EBITDA margins are under pressure, mainly due to the rise in the raw material prices and the inflation in the raw material prices, like milk, which is dairy products, which is important for them, is going to impact the margins. That's why we're going to see a decline over there. While in profits, the lower effective tax rate cut is aiding the profits, and that's why a 4 to 5% growth is what we're expecting in profits. Now, what are the factors to watch out for? We could have to watch out for the management commentary on how the demand is, what is the logistics status, especially with the COVID-19 impact, as well as the volume and the demand trends for COVID-19. Also, let's not forget, Nestle Global did say that India has continued to perform well for Maggi, Kit Kat and Naan. So let's see how that actually works out for Nestle.
Thanks very much, Vinny, for giving us that heads up on Nestle. Just taking a look at the markets right now, it's autos clearly taking leadership, followed by media. IT too is in the green. Metals up about 1.5%. It's the Nifty Bank that's taking a bit of a backseat today, and PSU banks too are lagging in trade. Nitin, wanted to get in your take on the auto space. This morning we were chatting with Saurabh Mukherjee, who seemed very bullish on the sector as a whole, saying that once things settle down, there's going to be lots of demand coming in, two-wheelers, four-wheelers across the board, and that they will be in a very advantageous position. Would you concur with that assessment? Do you think that now is a good time to enter into some of the auto names that have had it rough for quite some time now?
Yeah, so I mean, auto as a sector has been going through a cyclical downturn for quite some time, as you rightly said. I think in terms of coming back strongly, I would I would see pockets of the industry doing better. So I would believe that, this whole so-called social distancing norms would probably percolate into more of demand for two-wheelers at the first level, because, that's more affordable, especially when people are coming back, where people are not going to have hikes in income. And in fact, the unemployment is also high. So I would believe that, plus the rural economy is doing far better. So I would think that the two-wheeler segment is the best placed among the lot. Economic activity would be led, of course, by government capex programs. So you would see some demand coming in CVs and so on and so forth. But passenger cars, I sort of, find it a little difficult to believe that just after the lockdown is lifted, people are going to go rushing out and going to buy passenger cars, considering the impact that has been seen on incomes. Yes, you're starting on a base which is virtually zero. So, of course, you're going to see some element of bump back. But, I really would place my bets more on the two-wheelers and tractors as a whole.
Okay, two-wheelers and tractors it is when it comes to auto. What about the prospects for the capital goods sector? Because this is one that has a lot of challenging times ahead, be it the kind of capex that's really going to be constrained, the cash flows will be hit on the back of the liquidity squeeze, infrastructure creation as well is going to see a contraction, there'll be lower tax collection, execution delays will be evident as well. So it looks like it's going to be survival of the fittest when it comes to this sector. Would you be betting on names with resilient balance sheets and those that are likely to stand it out or weather the storm when it comes to the pandemic?
Well, you scared me by giving me a whole list of negatives on the sector already. So I think the sector is, rightly said, going to be challenged. It's basically companies who will benefit from government spending, those areas. So I would want to believe that the capital good equipment manufacturers who cater to, say, road construction would probably be one of the people who would benefit to something, because I think that's an area which the government will really push aggressively. For the private sector, clearly you're seeing that they are all in a deleveraging mode. I mean, right from the largest corporate in the country, they all want to cut down debt and are trying to deleverage themselves. So I don't see them coming back over the next 1 year at least, because most of them will focus on actually ramping up capacity utilization initially. So so I mean, probably the only guys who I would look for would probably be around the road construction segment.
We've all been talking about as to how Pharma has really led the way in the recent rally, but what happens next? Do you see a segregation within Pharma, or would the rally continue unabated? Kunal, what's been your observation?
I think there's something very, very interesting which is panning out for Pharma Index. So, traders or investors might see that probably they might have missed the bus in the April rally for many of the pharma stocks, but the long-term charts are portraying completely different. So this is the first chart out of the three that how the Pharma Index is nearing a 5-year downtrending slope. Channel pattern, and it's just about at the cusp of a breakout. You can look at the circle pattern there, that the index is very close to a 5-year breakout, and that could be a big breakout which could happen for Pharma Index. The second chart, which is more on the indicator front, even that indicator, which is a trend indicator, it's a very, very well-known indicator. It's an Ichimoku indicator. So you look at the second chart as well, and the Pharma Index is just about nearing this kind of a long-term breakout on the weekly and the monthly charts. And the last time the index had given such a kind of a breakout, it started almost a multi-year rally. The third and foremost is when you look at the Pharma Index from a high of approximately 14,000 to a low of around 6,200 to 50, which it tested 2 months back, it's completed a 61.8% retracement. So even on the overall structure wise, and I'm talking about the last 12 years, 13 years of structure for Pharma Index, it's completed a perfect classic 61.8% retracement structure. Now in that regards, when you're looking at the long-term aspect, what I'm trying to indicate is that what transpired in the month of April for Pharma Index could just be a short-term trailer, and I think the bigger trend could probably lie ahead. The index is very close to a breakout, and if you look at the strength in a lot of the pharma names, it still indicates that there is much more firepower for many of these pharma stocks to go higher. So I strongly believe that this is one sector which a longer-term investor should definitely keep a watch on, and especially the stronger names from this pack, because they could lead the charge from the front. And this could be a very big rally, a 5-year downtrend. When it gets replicated, it could probably start at least a 2 to 3 year rally. And we've just about started 1 month of this price rally for Pharma Index.
Absolutely. Pharma clearly seems to be the most sought after. Nitin, why don't you reiterate your views on how you think pharma should be approached right now? Because, when it comes to the vaccine, it's only the unlisted players which are in the game right now.
Sure. So, to be honest, we would like to play this very selectively. We think a lot of what has gone into the rally has is sectoral shifting that has happened from the financials. Factually speaking, if you look at most of the large companies, except for the fact that maybe they might get faster clearances from the regulator for their facilities, on the ground, nothing really has changed. I was just on a call with an international pharma analyst, and they were talking about the fact that how in Europe, all the pharma companies have actually beaten estimates and have done very well this quarter. But that is more a one-time phenomena because of people stocking up on medicines, which is not going to happen in the next quarter, and so on and so forth. Further, I think the important thing really is that yes, generics will do well in the shorter term because there is, given the whole healthcare costs going up dramatically, there is going to be, more and more focus on people trying to manage with generic and cheaper medicines. However, even there is going to be pressure on the regulator to see that there is no pharma company who has, while on one hand they might give you, make the regulatory norms easier for you. On the other hand, they might also, and they're clearing drugs faster. So you might further see pressure on the generic side. So I would rather play it stock specific and valuation specific. I think where you have very, very rich valuations, I don't think it's not going to be commensurate with the kind of growth that you're going to see for these companies.
Okay. Let's also go across to Varun. He's taking a look at what we can expect from Bandhan Bank's number this time. They will be in focus given all that's been going on with the bank. Let's take a look at what the estimates are.
Bandhan Bank Q4 numbers will be out tomorrow and they're looking quite decent. The NII is expected to come in at 1,500 crores versus last year's 1,250 crores based on our poll, and versus last quarter's 1,540 crores. At the profit level, the poll indicates a 700 crore profit this time around versus last year's 650 or last quarter's 731. The specific things to look out for are the moderation in growth in the key market of Assam, as well as in the group portfolio. There's been some headwinds as well, so growth has moderated there. This is what brokers are saying. Also, you're going to see higher provisions. So we've seen that with every single bank. Bandhan will be no exception. It'll just be interesting to see what that figure really amounts to for them and what specifically their COVID provision is, because that's where a lot of banks are really stepping on the accelerator. Recent collection efficiency will also be keenly looked out for. And the recovery of the deposits, we know the deposits and advances have been quite good. Total deposits grew 4%, CASA deposits grew nearly 12%, and CASA ratios also improved. We know all this from the Q4 business update. It'll just be interesting to get a final closure on it for the year. And so broadly, the Q's coming out quite good. From Jan to March, the collection efficiency for Bandhan Bank has been 98.7%. That's what they reported in the Q4 update. So that was fairly decent as well. We'll update you more with the final numbers tomorrow.
All right, so waiting on a whole host of those numbers. Meanwhile, of course, You know, Nitin, we also spoke with SBI Cards after their Q4 with a 400 crore impact on the bottom line post-COVID. They sound quite, we're trying to sound fairly reassuring going forward as well, talking about bringing back confidence, so on and so forth. But what's your sense when it comes to, that business angle and how things may shape up over the next couple of quarters?
So I think clearly there are short-term challenges. And, when we went and looked up what happened post-2008 with, let's say, an Amex in the US, and what was because we didn't have any such listed entities in India. So when we looked up some of the credit card companies and saw that there was clearly a rise in delinquencies and a slowdown, in the following 6 months and so on and so forth. So I think SBI will also, or all the credit card companies will go through their share of challenges in the short term. But I think in the long term, if you think about it, if you're going to have more, people wanting to keep social distancing, people wanting to keep work from home and call things home, and unlike the old cash on delivery, people don't really want to do that. You will once again see a recovery in the volumes. And people would be extremely wary of wanting to spoil their credit scores going. So yes, there will be a short-term pressure because of the moratorium that is being allowed. But I think longer term, the business is poised for a good comeback.
All right, thanks for that, Nitin.